Hi there, my name's Jeremy Cross, partner in Cadwalader's Fund Finance Department in London. It's my great pleasure to introduce you to another Fund Finance Friday conversation, and my even greater pleasure to introduce Spencer Goss, who is a Senior Director in the Fund Finance Unit at the Royal Bank of Scotland International. Spencer, welcome to the presentation.
Thanks for inviting me, Jeremy. It's good to see you.
It's a pleasure, it's a pleasure. So what we're going to talk about today is essentially the way things were, without getting too rose-tinted about it, or indeed telling everybody how incredibly tough it was 15 years ago, and to draw some interesting, hopefully, comparisons with the state of the market then and how we all saw things, and the state of the market and how we see things now and going forward, because we talk a lot about the latter and how we are doing now and what's happening and what's going to be happening. We talk a little less about the development, and I think some of the perceptions about that development. And I'm very pleased that Spencer has agreed to come and talk to us about that. So Spencer, can I start by asking you, just in your own words, how you as a lender perceived and acted in the fund finance industry 15 years ago? So sort of set the scene for us a bit, if you don't mind.
So, I mean, 15 years ago, I think it was largely a relationship-led sector. So, you know, leaning heavily on the institutional relationships that had been developed through the leverage and equity finance teams. So, you know, if you think about the UK leverage finance market, in the early 2000s, the Scottish banks, you know, were kind of dominant. So RBS and Bank of Scotland, and they were really the leaders, I think, in the fund finance market at that time. Bear in mind, I think it's important to bear in mind as well that you know, banks were often investors into funds as well at that time. So it was, you know, incredibly interconnected, you know, through institutionally. It's fair to say that the market was, you know, predominantly subscription finance. Although interestingly, I'd suggest that, yeah, the shape of our book back then was probably pretty similar to how it looks now. So, you know, 85% subscription finance, and, you know, 15% asset-backed, NAV-based finance. And I think that's the shape of our book today. Facilities were largely bilateral and often quite sizable. So, I mean, I have a vague recollection that we did a, you know, $1 billion bilateral at one point, which, you know, it's unheard of now, right? And that I think was made easier, but because facilities had shorter tenors. So 364-day revolving facilities were kind of, you know, the primary structure. Because these lines were really only designed to support administrative and operational flexibility for borrowers, there was very little strategic use of the facilities. I mean, overarching everything, I think, was the relationship between the institutions. You know, there was a mutual reliance on the bank and the borrower to simply make these nice to have products work for both parties. But yeah, there were only really a couple of banks, as I said, operating in the space, only a few handful of law firms playing. And so that there was definitely, I think, standardization and consistency across documents and lenders, just not through the LMA maybe.
Yeah.
And security, yeah, I mean, it always used to be, you know, we'd need a power of attorney. I think the security standards improved, and we learned from, you know, when the likes of Wells and Citi decided to target the UK and European market. And you know, they brought the standards up, I think.
Yes. No, I certainly saw a step change when the US banks in particular, I think, got involved in a change in approach that was noticeable.
Yeah.
I thought it'd be helpful to talk about some of the products, because we touched on this a little bit, or you touched on it a bit earlier, that we talk a lot in the fund finance community now about new products. So we talk about and assume perhaps that the market 15 years ago was subscription finance, and that almost everything else that we now do is sort of new. So I'm just going to sort of take a few products at random, see what you would say about each of these, and whether they were products that you had seen or were seeing 15 years ago, or whether they are really new products. So I'll start with the easy one, or hopefully the easy one, which is subscription finance. So 15 years ago, how do you think the market was in terms of subscription finance?
The high level concepts, I think, have largely stayed the same. It's just subtleties around the edges, right? So
yeah,
now we see borrowers asking for longer term facilities and looking to draw for longer within that. 15 years ago, LPAs restricted borrowings to kind of 3 or 6 months, and that was pretty standard. So we see borrowers looking to use subscription lines for more purposes now. It's not just operationally bridging the equity into an investment. It's just become more strategic use of the product. But the high level concepts have largely stayed the same, I'd suggest.
Yeah, I think that's right from my perspective as well, that it's been an evolution of a similar product rather than a step change.
Yeah.
So what about NAV financing, which I know has been a sort of hot topic of conversation now for many years.
Mm-hmm.
15 years ago, would you say there was a NAV financing product? Was it prevalent in the market? What sort of percentage, if there was any, was it to the subscription finance product?
Yeah. So I think there was NAV-based financing back in the early 2000s, and definitely less so for a single primary private equity fund. But for fund-of-fund borrowers, and we were pretty active supporters of secondary funds, for example,
yes.
and providing leverage into those. So the concepts have always been there. I guess where NAV-based financing has really accelerated it is with private credit funds, debt funds.
Yeah.
Where they're looking for a degree of leverage to enhance returns. That's probably been the catalyst for more conversations around NAV-based finance. But again, the construct and the concepts were there. It's lending money against assets, right? At the end of the day.
Yeah, that's true. And I guess if I was being very loyally about it, say that's pretty much what every type of lending product is.
Yeah.
So yes, you were lending against assets at the fund level. And I certainly remember doing deals with Royal Bank of Scotland, as it then was 15 years ago, which were NAV deals. So moving on from NAV then, pure NAV, what about hybrid? So what about the deals? And by hybrid, I mean a sort of pure classic hybrid. So a deal that had both elements of NAV and elements of subscription finance.
Yeah, not really.
Do you see them then? Do you think there are a lot of them around now from your perspective?
Not really then. And I mean, in truth, I think we probably still see fewer true hybrids pursued by borrowers now relative to the amount that we seem to talk about them in the market.
Understood. Thanks, Spencer. So another product that is quite prevalent now, and question whether it was so prevalent 15 years ago or whether it was around, I'll lump it together, was sort of GP financing, manager financing. Now, there may be a difference in that 15 years ago, that may have been provided by some lenders, but not all, or at least less of a group of lenders. I mean, again, did you see that product around 15 years ago? And if so, was it a sort of Royal Bank of Scotland type product, or was it other lenders who were making that available?
Yeah, no. So I mean, we did. It was only ever a relatively small part of our book back then, but we did. For key relationships, absolutely, we would look
Yeah.
to support them there. I mean, again, I think the growth in GP and manager lines is really reflective of the growth in fund sizes,
Yes.
and the obligation that's placed on those senior individuals within the sponsors to commit so much of their own personal money.
Yes. Yeah.
And so they need support with that. So that's why we're talking about it more. But again, it's something that was around back in the day.
Yeah. Yeah. Thanks, Spencer. So one other product, and then I'll let you off, because this is becoming a bit like a quiz. Preferred equity. So there's again a lot of talk about preferred equity or pref equity. Quite a few deals have been done which are pref equity based deals. Did you see that around at all 15 years ago, or would you say that was done either in another way or not done at all?
Yeah, I mean, we never saw it, right? So
Yeah.
I wonder whether that kind of need that's being talked around now and driving the growth in pref equity was solved back in the day by sponsors just tapping into investor capital through a different mechanism, whether they were raising side pockets of co-invest money for certain situations, but it wasn't something that we ever really saw.
Yeah, okay, thank you. So in terms of the evolution of the market then over the last 15 years, and one phrase that I used in thinking about this conversation was there's nothing new under the sun. Would you think that mostly this is sort of an evolution rather than revolution in the last 5-10 years, or do you think it's a revolution? It sounds more like an evolution to me.
Yeah, I do. Absolutely. I think it's been an evolution, and it's all led by borrower needs, right, and borrower behaviours. So, again, as I said earlier, the fund finance market in the UK was built off simple revolving credit facilities that private equity funds used for operational flexibility. That was the foundation of it. As soon as borrowers started to be a little more strategic or smarter in their thinking, and also raise money for other assets, like private credit or infrastructure, then their needs changed, and so it's inevitable that lenders adapt to keep serving those needs, really. Yeah,
I think that's very fair. So moving on, in terms of risk perception, because one of the things that I remember from 15 years ago, and certainly up to the great financial crisis, was that there was a perception that the product, and I'm talking primarily here about subscription finance, we might come on to NAV finance later, was and I'm going to use a lawyer's term, not a credit term here, but a relatively safe product.
So, Joe, I mean, if you think about it, back in the early 2000s, RBS was on a mission to grow its lending book and putting money to work in a low-loss sector like subscription finance was a way of achieving that. I mean, we'd already been supporting funds since the early 90s. And so we had a decent set of data to sort of evidence that there was a relatively small risk of loss, right? I think what we learned from the global financial crisis, which was a banking crisis, remember?
Yes.
Was that our customers were very supportive of us. So they worked with us to help us out of a hole, so that when we steadied the ship, we would then be able to get back to continue supporting them. And it sort of comes back to my point about the strength of relationships and connectivity between institutions at that time. We benefited from that. I think it's probably fair to say that we're still to see any significant investor defaults impacting our facilities. And I think that's reflected across the sector.
I think that's... Sorry, go ahead.
There was obviously the Abraj incident a year or two back, but that felt a pretty exceptional set of circumstances to me. And ultimately, borrowers and lenders, right, are still aligned in not wanting to see investor defaults.
Yeah.
And so the risk to a lender remains low, I think. You referenced pricing in there as well, and the evolution of that
Yes.
over time,
Yeah.
how closely that is aligned to risk. I mean, personally, I think the variations that we've seen in pricing have really been driven more by the supply-demand dynamic than any material changes in risk profile over the years.
Mm-hmm. Yeah, I think that's fair, actually. When we talked at the beginning of this discussion about the banks who were involved in the market, the lenders who were involved in the market 15 years ago, I think you said it was basically Royal Bank of Scotland, Lloyds, and one or two other clearing banks, and that was pretty much it, which may be a slight understatement or overstatement, but obviously, we can all see that that is completely different now. So again, just a brief comment, if you don't mind, about how you see, if you like, your competition now as Royal Bank of Scotland or RBSI, as opposed to how you saw it 15 years ago.
Yeah, sure. I mean, I think I saw something recently that suggested there might be 50 banks providing fund finance in some shape or another now. And there's also, I think, as you said earlier, Jeremy, an increasing number of non-bank lenders operating in the space too. I mean, yeah, I think that's great for customers, right? Alongside the increased liquidity that's around and competition, having more people thinking about any issues that clients may have can only be a good thing, right? Yeah. And even for us as a lender, I don't think that increased competition is all bad. We learn from the insight and challenge of other lenders, right? Whether we see that directly when we're working on a syndicated facility, or we sort of learn through what advisors are telling us on how the market's moving, or law firms like yourself. We benefit from that and constantly raise our standards. And ultimately, despite 50 banks operating in the space and whatever else, we still manage to grow our book at about 7 or 8% a year. That could be that we're great and we get a disproportionate share, but I think it's more reflective that it's a significantly growing market. Customers have much more significant needs, and we need all of that liquidity in the market to serve the client's purposes.
Yeah, thank you. That's a great answer. I think competition is always healthy to a certain extent, and you're right that having had this exponential growth in competition is not a bad thing. I mean, I remember seeing this particularly, I guess, around 2008, maybe a bit before, particularly when some of the US banks started coming in, and with a different proposal, different way of looking at the world. And it's remarkable how much that way of looking at the world has now taken hold in a way, and people have learned from it, people are following it, and I hope, and I'm sure that they are following some things that were done previously, prior to them coming in Europe by yourselves and other banks. So this has been really a great discussion. I hope it doesn't come across too much as two old men looking back in time. As you said at the beginning, it's not through rose-tinted spectacles. There were plenty of good things happening 15 years ago, plenty of things that may have been nascent, but are now happening more. So if you look back and perhaps forward over your career, at least in fund finance, over the past 15 years, how would you sum it up? I mean, just in a few words, what has it been like? Why have you done it for so long? The polite answers only, obviously. And will you come back in 10 years' time when you and I are both even older and do this again?
Well, so I think I've been very lucky to have worked in fund finance for as long as I have. And I'm sure there's a lot of people that would say I have been very lucky to have got away with it for as long as I have. But, there's a lot of really great people in the market that cover our space. I've worked with lots of great colleagues, but yeah, other banks, there's really smart people, really personable people, some great customers who are always challenging us and presenting us with interesting problems. Advisors like yourself, Jeremy, and others around the market. And it's, I know it's a weird thing to say, but it does feel as though actually it's quite a collaborative sector. And that's quite nice, right? It's got a good feel to the space, and I've really enjoyed it. I mean, I have to say, I don't think I will be doing a follow-up with you in 2030, Jeremy. Probably you won't ask me, but also I'd be surprised if I'm still here then. But for as far as I can see, certainly for the rest of this year into next year, our pipeline and the things that customers are asking us for, it's going to be an exciting time, right? There's going to be challenges, I'm sure, but that's good, right? It's interesting. That's what keeps us all going. And so I think that there's lots of reasons to be excited for the sector looking forward.
Great. Well, thank you, Spencer. I mean, I'd endorse all of those comments from my side as well. And it's been great working and hopefully continuing to work with you and many others over those years. So I haven't got anything else to ask you, no more quiz questions about types of products, etc. But I just wanted to say thank you so much for coming on, taking the time to both reminisce in a non-rose tinted way and to look forward and to tell us about how the market has changed. We all have our perceptions, but it's good to have a bit of a sort of reality check from people who have been in the market a long time. So thank you for that. It's been great and a privilege to talk to you about that. So thank you very much for coming on. I hope you enjoyed it. I certainly enjoyed talking to you as always, and hope to speak again soon. Thank you.
The material and information contained in the podcast is for general informational purposes only. Any use of the audio within this podcast without the express consent of Cadwalader is prohibited. Quotes from this podcast may not be used without the express permission of the speaker.